The doji that formed in the Dow on Friday showed a little bit of indecision, but it also indicated that if they opened lower today, that more than likely there was a wedge formation in progress versus a breakout. So the fact that the Dow opened up much lower today was an immediate indication that it was going to move in the direction of how they open after a doji, bringing us right back into this wedge. The fact that they gapped it down from a doji told you there was lots of force on the selling after the indecisive trading of Friday, that it was definitely time to close out long positions that were not showing great strength. The NASDAQ provided the same characteristic. We had a doji right about the same level it topped out before. The fact that we woke up and saw the pre-market futures showing a lower open after a doji day, again, told us they weren't breaking out, that the probabilities of trading lower was much greater, again, putting us back into maybe a sideways trend. This also indicated that the bullish strength had disappeared, that any bullish long positions in the portfolio that were showing weakness starting on Friday probably should be closed out, taking profits. And now, with the market trend in this direction, it puts us in a scan area to say we should probably be looking for shorts as if so any long positions that were in the portfolio needed to show compelling strength today, and we should be adding some short positions to the portfolio. The NASDAQ giving us the same impression. They're not breaking out, or I'm sorry, NVIDIA gave us that same impression that if the markets were not breaking out, the doji followed by a gap down told us we weren't in this direction. We were still stuck in this wedge formation, which means there isn't a big prospect for making a lot of profits unless you're very nimble. So you close out the trade immediately. You might not have made much money off of this trade, but the whole point of investing is to protect profits and close out positions that aren't working as fast as possible. But patterns are still working, and that's the benefit of knowing what candlestick patterns represent. We can see in our recent recommendation of repurchasing ARWR, the uptrend remained in progress today coming out of this fry pan bottom. Patterns are developed by investor sentiment over a period of time, and it's a buildup of either bullish or bearish sentiment, and it has very little to do with what the overall market is doing. So the benefit of a candlestick pattern is it's usually going to move in the direction of expectation, despite what the overall market is doing. There are expectations from a fry pan bottom or any candlestick pattern. Notice where they broke out. They gapped up through the resistance level. This uptrend remains in progress until we see a candlestick sell signal and a close back below the T line. What we call the classic fry pan bottom J-hook pattern, or what other people would look at as a cup and handle, as we see in lumber liquidators, is still moving in the right direction based upon the pattern that it was developing, even though the market in general was off a couple hundred points today. Each time we recognize what's happening in investor sentiment and a pattern that is reoccurring through the years, and that's the whole reason why we see these patterns, is because human nature works the same way time after time, creating patterns. All we do with candlestick analysis is identify those patterns and know what the expectations are coming out of those patterns. That'll be it. We'll see you in the chat rooms.